Well, three big U.S. banks will report their first quarter earnings in less than 24 hours. That's coming early tomorrow morning. Our next guest says it's the most keenly anticipated bank earnings season in more than a decade. Joining us now from Vienna, Austria, is Octavio Marenzi. He's CEO and founder of Opimas LLC. Octavio, thanks as always for joining us. I'm assuming that the reason you think this is the most anticipated set of U.S. bank earnings results in more than 10 years is, of course, the regional banking crisis that we had kicked off by the failure of SVB. Tell us more about what you're expecting from the likes of JP Morgan Chase, Wells Fargo, and Citigroup.
Well, it's not just U.S. banking. I think it's globally. I mean, look at the debacle we had with Credit Suisse just now. Basically, the same sort of thing unfolded where you had a run on the bank and people were pulling out the deposits at a furious rate, and basically the bank looked like it was going to collapse. So that's why I'm saying that investors are going to want to have a very, very careful look at these numbers to see what's going on. What I'm anticipating at the large U.S. banks is that we're going to see pretty good results. So net interest margin probably has crept up. We basically have seen lending activity continue to increase. In certain areas, commercial lending is up, credit card lending is up 10, 12%, depending on which bank you look at. So I think we're going to see amongst the very big banks a very robust set of earnings, even if deposits have started to crest a bit and come down. Now, the real question becomes what happens to sort of the medium-sized and small and regional banks in the US? Are we going to carry on seeing that kind of seepage out of deposits that makes it very difficult for them to sustain? If you look at the stock price of people like First Republic or Pacific West or some of the others out there, or even Charles Schwab, for example, it looks like the markets are betting they're not going to be able to recover anytime soon, and they're going to carry on seeing deposits flow out.
We hear from a lot of market watchers and economy watchers that they're expecting bank lending to contract, that there'll be less credit extended to borrowers in the U.S. economy. Do you expect that as well?
I actually do not. I mean, you can actually see the numbers more or less in real time, not quite. There's sort of a 1 week lag and delay on the Federal Reserve. They will tell you exactly how much bank credit is out there and how that's evolved. So we can see already for the first quarter, the first 2 months appear on the Fed's website, and it looks fairly encouraging. There had not been any big changes there in one direction or another, and they're all pointing up. Now, it might be in the second quarter we start to see a slowdown, and maybe in the last month of March we start to see a slowdown there in terms of bank lending activity, but it certainly was not visible yet in the first 2 months of the quarter. So I doubt very much that March declined that much that we're going to see a contraction there. But we are seeing deposits start to dry up, or the banks having to compete more aggressively for deposits. And so that's going to be the big challenge for them moving forward, is they're going to start to pay higher interest rates. They're not going to be able to offer people 0% and expect them to keep large amounts of money in their checking accounts anymore.
It was a strong quarter. The first quarter was for equity markets. One of the big wild cards in bank results, particularly for the likes of JP Morgan Chase and Citi, is their trading gains, trading in, for instance, things like fixed income, currency, and commodities. It's very difficult to forecast, but go ahead and take a stab at it.
With that introduction, very difficult to forecast. Let me nevertheless try to forecast what's going to happen. I think in terms of things like fixed income trading, I think we've seen a fairly robust volume in trading and a fair amount of volatility in terms of where bond prices have gone. So we've seen interest rates gyrate back and forth a bit in this first quarter, and that's going to be very good for those banks that know how to navigate choppy, volatile markets. And I'm thinking like people like Goldman Sachs are very, very good at doing that. Now, it's also very easy to get wrong-footed in those markets and then lose some money, particularly sort of the market-making activities that some of these banks have. So I think overall we're going to see fixed income trading do really well. Equity markets have gone up, but trading volumes actually are down a lot. So we've seen markets increase quite substantially, but if you look at the overall trading volumes in the first quarter of this year, it's down about 40%. So these are actually fairly thin markets. So on the equities front, yes, numbers are up, but a lot of the institutions out there basically are sort of agency-only brokerage institutions, and so they only get paid for the trades they execute and get a small percentage on those, or a small fee per share, and their volumes are down. So I expect to see fairly mixed results on the equities trading side and pretty strong results on the fixed income trading side.
Okay, there's a pretty good forecast after all. What would you be expecting, or what would you be wanting to hear from the top executives of the banks when they conduct their conference call? Jamie Dimon had a whole lot to say in his recent letter to shareholders, and he'll have more to say tomorrow morning.
Well, I'd like to hear what they have to say basically about the regional banks and what they expect to unfold there. Some of them have taken very large positions in the regional banks in the forms of actually direct deposits into them. So I'd like to hear what they expect to see that and what kind of reserves they're putting out against that, because they must expect there might be some losses. It's quite foreseeable that there could be losses within that. So they need to reserve for that. So I'd be curious to see how much they're going to set aside to say, this is the money we put into First Republic and this is how much we expect to lose. I would like to see what they're going to do about net interest margin moving forward, how they're going to retain deposits within the banks and discourage customers from taking their money out and putting them into money market funds where they're getting much higher return. So I think those are going to be the things. The other thing is, I suppose, how much are they going to set aside for loan losses? How bad do they expect the economy to get in the next 6 to 12 months? And what kind of losses do they expect to basically suffer on the loan portfolios? So those are the big questions I would want to see them answer.